All right, if you're running a business in New Zealand, you know the deal with GST paperwork, right? It's just part of the territory. Well, heads up because the rules for that paperwork have recently changed. So what on earth does that mean for you in practical terms? Today, we're going to demystify the whole thing, making it super simple and clear. Okay, let's jump right in. The biggest, most obvious change is just the name. We've gone from the old familiar tax invoice to this new phrase, Taxable Supply Information, or TSI for short. And I get it, you're probably thinking, great, more jargon to learn. But honestly, stick with me here, because the goal isn't to make things more complicated, it's actually to give you a whole lot more flexibility.
So, here's how we're going to break it all down for you. First, we'll look at the big shift itself. Then we'll get into the nitty-gritty of what info is actually required. After that, we'll explore who can create this information, which is pretty interesting. Then we'll cover how to handle mistakes, and finally, we'll wrap up with the key takeaways.
Right. First up, the big GST paperwork shift. This is really about getting our heads around the why of this whole change, and let's be clear. Think of this as an evolution, not some crazy revolution. It's all designed to bring GST record-keeping up to speed with how businesses work today.
So, how did we get here? Well, before April 1st, 2023, things were pretty rigid. You had very strict rules for what counted as a tax invoice. Then on that date, the new laws officially kicked in. And that means today, right now, we're all operating under these new, more flexible rules. So this isn't coming, it's already here.
So what exactly is taxable supply information? Well, officially, it's just the set of records you need to have to prove the numbers in your GST returns. And this is the key, okay? It's all about the information itself, not about one single specific type of document. You're no longer chained to that one perfect invoice.
And look, here's the best part. If your current accounting system is already spitting out documents called tax invoice, and they were fine under the old rules, you can just breathe. You don't need to panic and change everything. Because the new rules are more flexible, your old way of doing things is almost certainly still compliant. No need to rush and change the wording.
Okay, let's get into the practical stuff. What information do you actually need to have on hand to make sure you're doing things by the book?
Right. This is the big one, isn't it? The question that actually impacts your day-to-day. When it comes down to it, what specific details have to be on your records? Let's break it down.
So check this out. What's really cool is how the rules change depending on how much the sale is for. For anything under $200, you just need the basics: the seller's name, the date, a description, and the price. But go over that $200 mark, and you've got to add a bit more info, like the seller's GST number and the buyer's details. It's a tiered approach that just makes sense, especially for those smaller transactions.
And this right here is probably the biggest game changer. You are no longer locked into a single invoice. You can actually pull together the required info from a bunch of different places. A bank statement, a supplier agreement, a contract. They can all work together to tell the full story.
All right, so we've talked about what information is needed, but now let's talk about who can create it. Because this is another area where things have gotten way more flexible and, frankly, a lot more logical.
You know, the IRD gives this fantastic real-world example that just makes it click. Picture an abattoir buying sheep from a farmer. The abattoir is the one doing the weighing, the grading, and ultimately figuring out the final price. So it just makes way more sense for the buyer, the abattoir, to create the paperwork. And now the rules officially allow for that.
So this whole thing is called buyer-created taxable supply information. And honestly, the rules are super simple. First, you both got to be GST registered. Second, you just have to agree on it. And, get this, no need to call up the IRD for permission. Just make sure you both hang on to a copy for your records. But wait, the flexibility doesn't stop there. There's also this concept called a supplier group. A perfect example is your power bill, right? You're not just paying the power company, you're also paying the lines company. A supplier group lets them put it all on one neat bill for you. So much easier for everyone. And this logic extends to agents too. Think about property managers handling rent or your bookkeeper managing your accounts. They can now create or receive this information for you as long as everyone involved is registered for GST. It's all about making things work the way business actually works.
Okay, but we all know things don't always go according to plan, right? So what happens when you make a mistake? Let's talk about corrections and those special cases where the normal rules just don't quite fit.
So, if you've messed something up, maybe some goods got returned, or you got the price wrong, or hey, you fat-fingered the GST calculation, you need to issue what's now called Supply Correction Information. Basically, it's the new official name for what we all know and love as a credit note or a debit note.
And to make sure that correction is legit, there are just a few key things you have to include. You need the seller's name and GST number, the date you made the correction, and, this is important, a reference back to the original invoice so you can connect the dots. And then obviously, the details of the actual correction itself.
But what if you're in a situation where your business just doesn't fit the mold? What if providing the standard info is basically impossible for you? Are you just stuck?
Nope, not at all. You can actually apply for an exemption from the IRD, and the process is really straightforward. You just hop into My IR, send them a message explaining why the normal rules don't work for your business, and tell them what info you can give them instead. If they give you the green light, you just keep that written approval with your records. Easy.
Whew, okay, we have gone through a lot. So let's boil it all down. What are the absolute key things you need to walk away with today?
All right, here are your key takeaways. Number 1, flexibility. That is the name of the game here. You can use different documents, different people can create them. Number 2, don't panic. Your old system is probably still good to go. Number 3, just know what info you need based on the value of the sale. And finally, the golden rule that never changes. You've got to keep good records to back up your GST returns. Simple as that.
So you might be wondering, why go through all this trouble? Well, it's really about dragging GST record keeping into the 21st century. These changes are setting the stage for cool new tech like e-invoicing, where your accounting system can talk directly to your supplier system.
And that really brings us to the final question, doesn't it? This isn't just about ticking boxes for today, it's about getting ready for what's next. So have a think about it. With all this new flexibility and a clear push towards digital, is your invoicing really ready for the future?